I want to break down the problem we have around how you monetize AI. And we're going to do it in depth. And the reason we care is because there is nowhere that we are spending more right now in tech than AI. That's why NVIDIA's stock is going through the roof. And the thing that I want to call out is that we don't have a clear picture of AI monetization. We don't know where AI money is going to come from. We have a lot of hopes and dreams, but it's not clear yet. And I want to actually paint the picture because I have my gray hairs, I earn them. I want to go back a decade or more into another era of tech. And I want to talk about how this moment is reminding me a little bit of Uber and the hyper subsidized ride hailing experience that we got in the 2010s. So, Uber's investors spent approximately $30 billion over a 10-year period on subsidizing the ride hailing habits of Americans. And they paid so much money that they changed people's habits. People moved away from taxis. And the bet was once you change people's habits, they will stick with them even if you raise prices. And by and large, taxis have not come back. And Uber is making do with a combination of increased prices, up like 100% in some places, and with Uber Eats, which is very profitable for them, and actually their sort of biggest driver of profit margin going forward. And I'm thinking about that because at the end of the day, what we have with AI is similar, except the numbers are way, way, way bigger. We're talking about potentially $1 trillion in expenses over the next few years, at least according to a Goldman Sachs research note that came out. I think it was this week, last week, something like that. And if you're going to spend $1 trillion on things and you're looking for a conventional 5 or 10x return on investment, that means that you need $5 to $10 trillion in revenue for the companies investing in that capital expense to make this work. And so far, the only ones who are making an enormous amount of money on AI are companies like NVIDIA that are, as we put it, selling these picks and shovels in the gold rush. They're selling chips that other companies can use to train large language models. And that is moving, right? Like they are selling bucket loads. They can't keep them on the shelves. But if you go a level farther up in the stack and you look at what are the companies that are using those chips selling with AI, you don't come up with a lot yet. And that is one of the biggest question marks in tech right now. So, for example, Sequoia treats this as a $600 billion revenue gap. And they've updated that by a fair bit since just the start of the year. I think they doubled or tripled it. This was according to a research note they put out asking where the revenue for AI was going to come from, and that was only last month. That revenue gap keeps growing every month as companies invest more in AI on the hope of future revenue. And so my question is the Uber question. How long will investors tolerate this kind of capital expenditure? How long will the markets tolerate it if you're a publicly traded company? And where do you expect the revenue to come from? I want to put forward 3 different options that I think are historically plausible for where AI could pull that revenue from. Number 1 is a massive lift in productivity. And the reason I put that at number 1 is because I think that large language models' most useful and interesting use cases, for lack of a better term, are around how you can be creative. We made these large language models with the assumption that they would be logical. That was our default assumption for artificial intelligence in movie after movie after movie after movie. The narrative in science fiction was that way. The way we talked about AI, even before 2020, was that way in tech. It's just not that way. The large language models that became popular across the globe are highly creative. We invented creative AI first. And because we did that, what we are getting is an opportunity for productivity growth that we are all coming to terms with. And so if you want to look for like, where is a place where you could get a surprising amount of money, I think one of the options is breakthrough productivity driven by AI creativity. And that is not going to look like the efficiency gains that most companies are banking on. It's going to be much more growing the top of the funnel. It's going to be much more focused on how you can grow your sales, your revenue, how you can, as a company, invent a new product. I know that people are using large language models for research applications because OpenAI has talked about it. Those are the kinds of things that could yield disproportionate benefits. Imagine the revenue line impact if a large language model leads to a breakthrough that unlocks a new drug class, right? And now it's $100 billion, $200 billion, and there you start to attack that revenue line right there. That is not how Wall Street typically thinks about the potential of new technologies, because Wall Street is typically geared toward thinking about it in terms of efficiency gains. And so one of the things that I think is an inherent tension is that Wall Street is not really buying this larger vision that Sam Altman and others in the AI futurist movement have embraced. Wall Street doesn't see the dollars and cents adding up, and Sam is basically saying, and his friends and his colleagues and the rest of folks in tech who are close to AI and who believe in it are saying, just be patient, we will get there. We will see what happens. One of the analogies that comes to mind for me as a former Amazonian is Wall Street also didn't buy Amazon Web Services for a long time. I vividly remember picking up the magazine where I think it was Time Magazine, and it was like, Jeff, you should keep the store, was the headline. And it was like an entire article dedicated, an entire issue dedicated to this idea that Amazon was branching out inappropriately from retail and should not get into cloud computing. And we all know how that went, right? At the end of the day, AWS is doing pretty well. But the monetization wasn't obvious. Similarly, for Prime, if you look at the dollars and cents case for Prime, it doesn't add up. It's actually a fairly well-known story. Like, if you look at whether or not it made sense to launch Amazon Prime, the cost of 2-day shipping way outweighed the expected monetary value. And what people didn't realize was that by taking away that mental block that came with calculating shipping, you were going to unlock a ton of new demand on the internet for e-commerce. And that's what Amazon ended up doing. It was a case of what we call Jevons paradox. It's basically a case where if you drop costs down, you see demand go way through the roof. In this case, Amazon drops the cost of shipping. They remove this mental block, demand rises. So where does that leave us? At the end of the day, AI is sort of in the place where Amazon was when it was deciding on Prime, where Amazon was deciding on AWS, where Uber was when they were trying to figure out how you monetize off these cheap rides you subsidize. AI, as a collection of companies, as a movement, as a vertical in tech, is looking for monetization. They need it. Otherwise, the capital expenditure doesn't justify. So my first case was AI is creative. Maybe we find ways with AI creativity, like a drug breakthrough or something like that, and we start to chip away at that revenue gap that way. My second is the efficiency gains, but I want to ask where that comes from and why, because I think people tend to assume efficiency gains mean job losses. And going back to Jevons paradox, I actually don't think that's true here. I think efficiency gains are likely to lead to more demand for the work that is done efficiently. And that's something companies are missing right now. And so I think instead of looking at it as we can get stuff done with lower costs, yes, maybe the unit economics drop. Maybe it costs less to run a marketing campaign, but you can now do cooler marketing campaigns. And so maybe the dollar costs don't drop. And that's something that, again, Wall Street may not be calculating in as much. Like, they tend to look at it as very linear. And I think that's one of the things that will be interesting to see is, do we see these anecdotal reports where people are saying, I am getting more done, but there is always more work to do. And therefore, even though AI has helped me a lot, I am just getting through more of my infinite to-do list. It's not like the infinite to-do list has actually gotten shorter. And I think anecdotally, for a lot of us in tech, it is an infinite to-do list. And there's always things we could be doing. And AI is simply helping us to get to like 60% of it versus 40% of it. And so even if the productivity gain is big, it may not come through in like reduced salary costs or layoffs, which, by the way, is something that is really interesting to think about. There's some anecdotal evidence that there are layoffs associated with AI that are happening, but they're mostly anticipatory. It's mostly around, we think we can get away with this, and it's mostly associated with companies that have been struggling anyway and are kind of looking for something that gives them a narrative to turn the company around. It's less about hard productivity gains in practice driving hard layoffs. That one doesn't happen as much, at least not yet. We will see. So to me, that second one around efficiency gains is actually more about how can a company get more done, cover more territory, given the same workforce footprint. And we do see, like, I see a lot more conversation around people delaying hiring or slowing on hiring because they think they can get more done with the same number of people. That one may not be true in practice, in the sense that people may be over delaying. They may be taking that productivity lift for granted too much. People may get tired. They may burn out. They may switch roles. Who knows? But there's more to it there than there is from a hard-edged productivity cut perspective. So I want to pause there. So wrapping up the efficiency thing, I think there's two ways we play this, right? We have hard-edged productivity cuts and job losses from AI. I don't see much evidence of that. There's a few companies that are doing that are already in trouble and they're anticipating. I don't think they're actually like basing it on hard-edged facts of productivity in their company for the most part. And there's also the softer ones where they're slowing hiring because they see more efficiency. And my general point here is that if we are getting to more of our infinite to-do lists, you're not going to see that show up in the dollars and cents of the company because, well, we all have infinite to-do lists, right? Even if we're seeing huge efficiency gains. So what is the third way we could monetize? I talked about the massive lift of creativity. The example was, what if we find a new drug? I talked about efficiency gains, a couple of ways we could play that. And the last one I want to talk about is new markets and new devices. One of the things that's really interesting is that we've mostly interacted with large language models through a chatbot experience. Well, what if it's not just a chatbot? Imagine a world where you start to pair a large language model with an in-home household robot. That is a device class that doesn't exist yet. That is a device class that people have speculated may be worthwhile since the 50s. And we certainly have well-known entrepreneurs going after that device class right now, building it right now, with the explicit goal of inventing a new home device that people will pay a lot of money for because it's such a labor saver around the home. I don't know the future. We will have to see what happens. But one of the ways you pay off on LLMs is if suddenly they are effectively the operating system that powers the most ubiquitous rollout of a new device since the iPhone. And then layer on top of that, what happens if they're also powering iPhones, essentially, because Apple's in the middle of powering up their iPhones to do AI. It was a big factor in WWDC. And they may be more cautious than many, but they're still going after it. So I want to wrap this up and give you a sense of how I feel about it and where I land on this. I agree. We have a big revenue gap on AI. It is not trivial. I also agree that we are spending at a massive rate, and the people who are winning right now in this space are the people who make chips, which is mostly NVIDIA. We do have monetization that we need to find if we are proponents of AI, if we feel like there's value there. I think that the three options we have are essentially find ways where we can be more efficient, and I don't see that as equivalent to job losses. Find ways to use LLM's creativity to find breakthroughs and unlock disproportionate gains. And I see a play for devices as well. Does that add up to $5 to $10 trillion? I don't know. This isn't a math podcast. We will have to see how it plays out. But if I were to pull on those threads and say, where is the use case that companies who are investing hard money are anticipating? Those are the three that I would go after. Tell me, what did I miss?